Welcome back, everyone, to the Biz Beat by SVA, where we focus on the updates and insights business owners need to know. I'm Lee Schwartz, Director of Sales and Business Development here at SVA, and joined as always by Eric Trost, our not only tax partner, but our firm's president. Eric, how's it going?
I'm troubled, Lee.
I saw your face. You looked concerned. What's going on?
Yeah. Got a thing going on with our youngest daughter and the lunch table dynamics at school. And she's bringing some of that home, and you never know as a parent where to get involved with some of this stuff. But it's causing a little problem with I'll say drama with the baby mama, which is my baby mama is really my wife, Carrie.
Yes, no, I understand. And your daughter's in her early 30s, is that right? Or do I have that wrong?
Not quite.
Okay.
He's
I'm a
in
little
eighth
off.
grade. Yes. So it's
Okay.
the eighth grade lunch table.
Oh, middle school. That's the worst. That's
Yeah.
the worst. It's the worst time. She'll get through that. Once you get to high school, everything gets better. I think we can all. I don't know about you, Eric. Middle school wasn't my best time either.
Yeah. No. Actually, I really like middle school. High school was tougher for me, but middle
Okay.
school, yeah.
All right. Well, this is going to dovetail really nicely into our conversation on what are we talking about first? You want to talk about tariffs first? So,
Probably tariffs.
because what I'm thinking is your daughter's sitting at a picnic table, right? The weather's still great. She's sitting at a picnic table, but that picnic table is going to cost a little something different now. You see the transition? It's unbelievable. All right. So,
Yeah.
in all seriousness, though, there were some conversations earlier this week, or even some guidance put out by Trump about tariffs. You want to
Yes.
give our listeners a few nuggets of wisdom about what is going to change there?
Yeah. So there's been some new tariffs announced to kick in. Some kicked in on the 1st. Some are kicking in on October 15th or October 14th might be the date. The important ones, I think, are the new pharmaceutical tariffs, which there's 100% tariff being added for pharmaceuticals being shipped in. That undoubtedly is going to have some kind of influence on drug prices. And then the second large one is the lumber tariff. So a lot of lumber that comes into the construction industry in the United States come from Canada. So apparently they have lumber to spare up there. They sell it to us down here. It's already being hit with a 35% tariff. There's a flat 35% tariff. These were instituted months ago when Trump started doing all these tariffs. They're adding another 10% tariff. The government, U.S. government, is adding another 10% tariff to that lumber. So now that total tariff is going up to 45% for lumber coming into the United States.
So, Eric, obviously, home builders going to be affected, home buyers. Who else is going to be affected by some of these lumber tariffs?
The wooden toy makers. I guess anyone that's using lumber is going to take this, and you're right, is going to affect the home building, which a lot of these things they're mid construction right now, right? Or so what happens then? I'm not sure if home builders build this into their contract or not. Some might and some might not. As far as, hey, if there's costs that increase from the time you signed to the time we start building, you have a burden of taking on those cost increases. So there's some risk that's out there. How is it in the contract? It might be subject to that specific contract, but something to watch for, and what happens with home prices now, especially new home construction, is that gets blended in because, the lumber is such a significant cost when you're looking at home building.
Right. And you and I were chatting about this a little bit earlier, but knowing that Trump had truthed about this, I think last week, a lot of industry experts had assumed that these tariffs were actually going to be a lot higher. So in some ways, people are a little bit relieved. But Eric, it wasn't just lumber, right? They talked a little bit about furniture and cabinet imports as well. You talk about what those numbers look like.
Yeah, there's an additional 25% tariff now going on furniture and cabinets. So again, this does also function on the home builder side, is with these additional costs going in, when do they start and when do they start hitting? These are other ones that we're going to go in on the 14th. Trump, though, we've seen this in the past, is it comes right up to the date and says, oh, I'm going to delay it, or we're going to do something different. So remember, these tariffs, Trump is using them different than maybe past regimes have used them. He uses them as like bargaining chips on the table. He puts them on, he pulls them off. He's very active in pushing and pulling the levers of tariffs to try to, make things happen. So this isn't just, hey, here's a policy and here's how we're going to do this policy. This is more tactical, meaning that, they're perhaps part of a larger strategy. But from a tactical standpoint, these tariffs, they get turned on and they get turned off very quickly. So hard to plan for, but certainly is something to keep an eye on, because this may come into fruition, or if perhaps Canada makes some other deal on some other concession, maybe these don't get enforced at all. So you have to this is one you have to keep paying attention to the news on.
Yeah, and Eric, a lot of the tariffs we've been talking about in the past, you mentioned them today, the pharmaceutical, some of the chip makers, like those don't necessarily touch our clients in a huge way. Maybe a couple of them do, but this one definitely does. So if you're let's say you're a home builder, um, what do you do with this information? Is this something you can incorporate into your contracts with with your clients? What do you suggest owners of these businesses do?
Yeah, I think this goes to, and this isn't just tariffs, but it goes to when these contracts are designed, there's a certain amount of risk that you're taking, in that you're performing a obligation in the future based on something right now. And so what happens if those obligations to perform in the future have higher cost inputs? And one of them might be tariffs. And so how is that planned for within your contracts? To some extent, it really is. Are you talking to your attorneys about how your contracts are set up and what your risks are within these contracts, especially in a volatile situation like either a high inflation, which maybe isn't so high anymore, or in this environment where tariffs can be slapped on or off really quickly?
Yeah. So as always, I mean, pay attention to what we're talking about here. Pay attention to what's going on in the news. These things can change overnight, but definitely something to be thinking about and preparing for if you're in this industry or in an industry that's affected. So, good conversation there. I think before we move on to our next topic, I just want to make sure I mention, if you are looking for ongoing guidance and resources as far as the One Big Beautiful Bill Act goes, you can check out our hub at sva.com/OBA. That's three B's, OBBBA. We've got a ton of information there. Continue to update it. We're doing additional webinars and whatnot. So check that out for up-to-date information. Okay, so Eric, we've been talking a lot about OBA, but one of the things we haven't touched on in a little while, and there was some updates provided recently, was the Secure Act. Can you give our listeners a little bit of an update on the final rules issued by the IRS this month about the high earner threshold?
Yeah, so what you're referring to there is not OBA, as you said, but the Secure Act, actually Secure 2.0. Before I start that, I just had a thought in my head. Did you ever watch a movie and they had like a continuation error where, like in one scene,
Yeah.
somebody's holding a coffee cup in their right hand, and then the next scene it's in their left hand, but they keep going through as if, the film is normal, but there's those little continuation errors. Did you ever see those?
I don't know what you're talking about.
Okay.
I don't think those have ever existed, as a matter of fact.
Right. Anyway, back to the Secure Act. So what the rules issued have to do with 401k deferrals. So currently, 401k deferrals, you can maximum out your 401k deferral at $23,500. And that's a pre-tax contribution from your wages into a retirement plan. So that's what the 401k is. And if you're 50 or older, you can do an extra $7,500. So I actually know what that's like. I am 50 or older. And so I can contribute that additional kicker into my 401k plan pre-tax. So I've got 23,500 plus an additional 7,500, which is a grand total of 31,000 that can be contributed pre-tax into the 401k for 2025. Starting in 2026, if you are a high earner, and the IRS defines what a high earner is earning more than $145,000 a year. If you're a high earner, then you cannot contribute that additional kicker at 50 or older pre-tax into your 401k. What you're allowed to do is to contribute that additional kicker amount into a Roth 401k, which means that the Roth is good because it grows pre-tax and comes out not subject to any income taxes. So that's what the Roth means. However, it is not tax deductible going in. So when you do your kicker in 2026, if you're in that position and you're earning more than $145,000, that kicker cannot go in pre-tax. It's not a tax deduction going in. You're taxed on that money. You can still put it in, but it must go into a Roth account. And the plan must allow for the Roth account. So not every plan is designed the same. When the IRS allows for retirement plans to be designed, they give you like a menu and say you can have these options and you don't have to have these options. And the Roth 401k is actually one of those options that a plan can choose to check or not. So if you're participating in a plan that does not have a Roth 401k feature, and you fall under these rules that you're over 50 and you want to do a kicker, you actually can't do the kicker then.
That seems like that would be that's a big deal for high earners. Eric, if you work at a company or if you're an owner of a company that doesn't have this option, where do you see this going?
Yeah, and I think what the request is going to be from those that have the option available that are over 50, but also over that 145,000 of earnings is they might be calling their HR departments and saying, "Hey, how do we get this Roth option added?" Just because you design a plan or a plan is designed that does not have that Roth 401k option, that can be updated. So maybe contact the benefits attorney and say, "Hey, how do we take our plan if it doesn't have that 401k option, update it and turn that option back on so we can allow our folks that are over 50 and in that earning mark to still do their additional kicker?" So it's a benefit for the employees that you could end up turning on if it doesn't currently exist.
Okay.
But that starts in 2026.
2026. So I guess what I'm hearing you say is if you are a business owner or even, somebody that this is going to apply to, over 50 or older making more than 145,000, it's time to start talking to your HR department.
Yeah, that's right.
Yeah. Okay. Great. That's super helpful. Again, that probably doesn't apply to me for another 20 years, but I appreciate the information.
Right. The rules might change by the time you
Yeah.
edge to 50.
Right, exactly. Thank you for that. So, for backing me up on that. So, let's move on to our mailbag. As always, you can send us your questions at bizbeat@sva.com or drop them on our website at sva.com/bizbeat. So, Eric, this is an interesting question this week. So, not one I've ever really encountered in my 14 years here. The question is, we're talking about becoming foster parents. Are foster care payments taxable? What do you got for
Yeah.
that?
Yeah. And in general, the answer is no. Foster care payments are not taxable as long as they are from an agency that is like a state agency sponsoring the foster care. There's private agencies that might have payments that are taxable. There's adult care agencies that might have payments that are taxable, for example, taking care of adults with special needs. But foster care payments in general for children are not taxable. In addition to that, as foster parents, depending on if you meet the other criteria for the child being your dependent, that is basically you support the child, you can have available to you the $2,000 child tax credit. You can also have available to you the child care credit. So that's payments for child care for working spouses. So the foster care payments not taxable. In addition, foster kids can be dependents if you meet the test for supporting those foster kids. And so then you can get the child tax credit and perhaps the child tax or child care tax credit.
Okay. That's great. Thank you for addressing that. Like I said, I don't think that's something that comes up all the time, but definitely important to some really important people who are helping out kids who need it. So that's great. Well, I think That wraps up this week's episode of the Biz Beat by SVA. Make sure to subscribe on Apple Podcasts, on Spotify, or on YouTube. And don't forget to check out sva.com/OBBA, OBBBA, for resources and FAQs and past webinars, all that good stuff. And as always, my caveat, just remember, everything we talk about here is general in nature. It's not meant to be specific advice for you or your business. For that, please talk with your advisor. If you don't have a great advisor, contact me and we will talk about how to get you set up here at SVA as a client. Thanks for joining us this week, and we will see you next week on the Biz Beat by SVA.
It's the Biz Beat by SVA, breaking down the news of the day. From tax tips to business trends, smart insights from trusted friends. The Biz Beat by SVA.